Hey guys, what's going on? This is episode 7 of the YouTube stock portfolio, where we take a public portfolio and analyze some stocks and hopefully add some stocks to this portfolio and grow it over the next few months and years. In this episode, we're going to take off and continue on from where we left off last time. And in the last video, we very briefly went over Skechers and Wynn Resorts. And I've entered in those numbers, and now we're going to go through and talk about those numbers a little bit further, and then we're going to go through and continue our analysis, see what kind of expected return we can get on these stocks using my value matrix, and maybe we'll have a bit of a deeper dive into some of the other aspects of the business, such as the management team and that sort of thing. So if you enjoyed this video, make sure you leave a like and let me know your thoughts down in the comment section below. But for now, let's jump into it. Alright, so we briefly spoke about Skechers and Wynn in the last video, but I said that I would enter in the numbers off camera and then we could talk about them briefly at the start of this video. So having a look at Skechers numbers, in terms of sales, it's exactly what we like to see. They've got 13% long-term growth, or 12.5%, and then each and every year that's been improving, 16% in the last year, which is really good. EPS growth is a little bit different, a bit concerning. The long-term average is 12%, which is really great, but in the last year they actually they dropped their earnings down by almost 30%, which is a significant drop. We'd have to have a look into why that happened. And then of course we can see that 7-year average at 3%, which means that their earnings really haven't been consistently growing over time. It looks like, as you can see from the numbers here, it's just all over the place. So I probably won't be investing in Skechers. I think it's just a little bit too all over the place. Equity is really good, but again, free cash flow, too many negative free cash flows for my liking. Too many times where they're negative. And that just means that they don't have any money left over to invest. And not only that, if they have negative cash flow, it means that either their cash on their balance sheet is going down when they have that negative cash flow, or they're taking on more debt. Neither of which is a good situation to be in. So I'm actually going to go ahead and delete Skechers from our list, and I'm going to delete Ford as well, because I wanted to keep Ford because I didn't know how good the numbers were going to be for some of these other ones, and Ford really just didn't have good numbers at all. So I'm actually going to delete that as well. And then now we can have a look at Wynn Resorts. So let's have a look at their numbers. So before we look at their growth numbers, I want to draw your attention to the management effectiveness section of my spreadsheet. So return on invested capital, we don't even have a 5-year average, because as you can see, they had negative equity for a number of years here, which means that the debt that they had, the debt that they owed was worth more than the assets that they bought with that debt. The assets had declined, but obviously the debt stayed the same. And that's a really, really bad sign. I hate to see businesses in that situation. Sometimes they're okay, and if you understand the business, it always comes back to, if you understand the business completely and you know why the company operates in a certain way, then it's completely fine. Like, if you understand that operating in negative equity can be okay, then that's great. But for me personally, my expertise is in working with companies that are growing their equity over time, because equity is essentially the intrinsic value of a company, and I like to see that it's not only positive and not negative, that it is growing over time. And the 1-year ROIC isn't really much better. It's not even 10%, which is a really weak ROIC. And if we're expecting as shareholders to be able to make 15 or 20% on this stock per year, we can't really expect ourselves to be able to get that from a stock that is only producing 7 or 8% returns internally. So with the money that they're investing, the capital that they're investing, they're only getting a 7.74% return on it, which tells you straight away that we're just not going to be able to make a high return on this company over the long term. Maybe they're making a high return now, but these investments that they're making, they're not producing really, really high rates of return. So over the long term, their growth is going to slow down and sort of start to represent what this ROIC is. So that's a really, really bad sign. Then we've got the debt ratios. How much debt is this company operating with? And I understand that it isn't. It is a hotel business. They operate resorts and that sort of thing. So it kind of makes sense that they have a high amount of debt because they're purchasing property and making developments and that sort of thing. So it makes sense. But again, my expertise is in businesses with very low levels of debt, because it means when we go into a recession and credit freezes up and it's difficult for these companies to get more debt to cover their payments, we're not going to be in trouble as a shareholder, and we're not going to have to worry about a company going bankrupt. So I like to see a current ratio of above 2. They just missed that, but they're doing quite well. That's actually quite a good current ratio. I'm happy with that. But the concern with Win comes with their debt to equity ratio. They have over 12 times as much debt in this company as equity. And I like to see a debt to equity ratio that's below 0.5. So this is vastly different. So the reason that the current ratio is okay and that the debt to equity ratio is not that great is because they don't have many current liabilities. They don't have any. They don't have much debt that's due in the next 12 months, but they have a heap of long-term debt. And of course, that comes back to it being a resort. So they would be buying property and taking out really long-term debt, maybe 30-year debt or 40-year debt or something like that. So that's why they've got such a high debt to equity ratio. And for me personally, it's just not worth the risk, because I don't understand if they can operate successfully with that amount of debt. I'd rather just skip over all the businesses with large amounts of debt and just focus on the ones that have low levels of debt and that are able to control the levels of debt effectively over a long period of time. So then we can have a look at the growth numbers, and again, it's just not great. It's just not uniform. It's just not clean. And sales growth in the last year has been really good. So what you'll notice is that the 1-year numbers are exceptional, and this is represented in the stock price. The stock price was rising rapidly up until that point, but you can see from 2016 to 2018, the stock tripled, doubled? Yeah, it tripled in size. So it went from about a $60 share to about a $190 share. So it rose really quickly in that period, and that was down to this short-term period of really high growth. But their long-term growth has not really been that good. EPS growth has been good, but that 9-year number probably includes some numbers, some really, really low EPS numbers around the recession time. So it could be misleading. And I found that when I was looking at Thor's numbers, theirs was a little bit misleading because they had really poor earnings in the bottom of the recession, and now we're at the top of a boom, and therefore it gives us a really inflated growth rate. So I would be hesitant to use that. And if you look a bit closer in the 5-year, you can see what their growth rate is more realistically like, probably in the 8% range. And their 3-year, they really haven't moved at all in the past 3 years, which is now why their stock is probably starting to come back down. Investors have realized that this stock is way overvalued. It has a PE ratio of 74, which is just insane. But it's just not an easy business to look at and know that we're going to be confident in using these numbers going into the future. So again, we're going to get rid of Win Resorts. All right, so unfortunately, we've actually narrowed this down to 4 tech stocks, really. We've got Apple, Amazon, and Google are all tech stocks, and Stamps is an online internet-based stock. So they're all in the tech sector. Unfortunately, we don't have a bit of diversification here, but when we do this again in a few weeks and we go through and we shortlist some more stocks and go through them again, hopefully we'll get some other industries and we can diversify across industries a little bit better. But now what I really want to do is I want to use the long-term growth rates and start to make some assumptions about where this company will be going over the next 10 years. Now, remember, in order to make accurate assumptions, you need to understand the company really thoroughly. And if I was investing in any of these companies, I would make sure that I completely understand the business. This meaning checklist here, circle of competence, because we can look at these numbers for Stamps, for example, and if we don't know anything about the company, we might be tempted to use a growth rate in this range, a 20 to 40% growth rate. And that is just way too high, and I'll explain why. And actually, I just released an individual stock analysis on stamps. So if you want to hear my opinion on the future growth of this company in detail, go check out that video. All right, so we'll start out by looking at the value matrix for Apple. And so basically how my value matrix works is when you just download the spreadsheet, it'll automatically, in these areas here, in the growth rates on the bottom table, it'll break up. What it'll do is it'll take an average of your long-term growth, so of these numbers, and it'll break it up to give you a little bit above the average and a little bit below the average. But what I do generally is I sometimes manually enter these, and that's what I've done with Apple. I've manually entered 5%, 7.5%, 10%, 12.5%, and 15%, because as you can see for Apple, the long-term growth has been really high, and I just don't think that is realistic going forward for Apple, because they're not in that hyper mode innovative stage of their business where they had the iPod coming out and the iPhone, and that is what was driving this really strong long-term growth. And as you can see, it's slowed down in recent times. So that's why I've picked some lower numbers here. So you can just go in here and manually change these if you want. And that's exactly what I've done. And then we need the EPS, the time frame, and the price. So let's just jump over and see. So Apple's price is $227 per share, and the EPS is right, I think. Yeah, the EPS is right. So 227. Let's put that in. Oops. I wondered what I did there. That's funny. All right, so basically, also, I forgot to mention the PE ratio. You can also change this. Again, change it on the bottom table, because the top table does it automatically. But what it does is it takes the average, the high, and the low, and it puts them into there, so that you get a wide variety of potential PE ratios in 10 years' time. Because remember, we don't know how the market is going to value this stock in 10 years' time. They might give it a 20 PE, they might give it a 10 PE, and it really depends on how much optimism there is in the market. Right now, I think Apple has a 20. Yeah, Apple has a 20 PE, but not too long ago, it had an 8 PE, and it rapidly grew. I think it was about 3 years ago or 2 years ago, it had an 8 PE. And you can see that the stock price rapidly grew from there to there. So we would ideally want to be selling this at a high PE, in the 20 range, but we have to anticipate that we might not be able to, and that maybe the market just doesn't really like Apple anymore in 10 years' time. So we're prepared for that by having a range from 10 to 20. And one other thing I like to do is I like to go over and check what the analysts are saying about the company over the next 5 or 10 years, so to see if we're in the ballpark of that. So let's go and have a look on Yahoo Finance, and we can find out what the analysts are saying about Apple. So if we scroll down to the bottom, we can see that the analysts think over the next 5 years they'll do 10.75%. So that pretty much fits our table here, but we're actually looking over 10 years. So we could adjust this to 5 years, and you can see that it doesn't look great at the current stock price, and I probably agree that it doesn't look great at the stock price. Down here, I've added a little table to add the capital gains and the dividends. So the capital gains is just taking the what we expect to get, which is just the middle part of the table, 10% growth and 15% PE, and then the dividend is just their current dividend. I just put that in there. So you can see that at the current stock price, it doesn't really look that good at all. I'm curious, actually, back in 2015, let's have a look at what kind of buy. So when Buffett was starting to buy this company, about in the end of 2015, start of 2016, I think it was, he started buying at about $100 per share. So this was in 2016. It was $100 per share. So if we change this to 100, and the PE, the EPS at that time was $9.22. So we can add that in as well. And you can see it was about an 11 PE. This was what the table looked like when Buffett was starting to invest in the company. So you can see that the downside was, not bad at all, and the expected return is in the 17 to 18% range, which is really great. And since then, earnings have only gone up from $9 to $11, but their price has gone from 100 to 127. So what did their earnings go up? About 30%, just between 25 and 30%, but their price has gone up 120%. So you can see that prospect for making lots of money in Apple has really gone away, and we'd need to wait for a recession. So one last thing I'll do is I'll jump over to the buy zone calculator and I'll put in that 10.75% growth rate. And we'll go over a 5-year period. And we'll assume that we're going to be able to get a 2% dividend. So we can take off 2% from the required return. That would give us a buy price of $74 per share, which is a long way away. So we'll put Apple in our back pocket and we might invest in it just for the sake of the series. But you can see that I personally wouldn't invest in Apple until it came down a long way. We're talking 60-70% drop in their price. All right, so we'll just do one more before we wrap this episode up. We're going to have a look at Amazon. So let's grab the Amazon current stock price. I think it's changed a little bit since the last time I entered in their numbers. Yep, so they're just over $2,000 per share. So we can enter that in. And their earnings per share is $12.63. So put that in as well. And we'll look over a 5-year period. Okay, so and this is, I talk about Amazon a little bit sometimes, from time to time. I think I've more talked about it in comments where I've seen people saying that, I've seen people say that Amazon is a buy at any price. And this value matrix should tell you that that is absolutely BS. I won't swear on here, but that is BS, because even if Amazon grows at 20% per year, which is a really high rate to grow at, they'll probably do it, but it's a high rate to assume. And they have a PE of 25, which is still above the long-term average. The long-term average for the stock market is 15. For a growth stock, maybe in the 25% range. That's probably fair. You will make negative 17% every single year. So which would put the stock price at under $800 per share. So the multiple that you're paying on Amazon, you can see that the PE ratio at the moment is 160. And at some time in the future, that's going to come back and normalize to the market levels, or it should. And you should expect that it will, because most stocks operate in that way. So even if you assume a 75% PE ratio, which is half of what it is currently, but it's still way too high, and you assume 30% growth per year for 5 years, that's insane. You wouldn't make your 15% return. So you've got to be careful with stocks that are really, really popular and really overpriced. Now, we should probably pick, let's have a look at what the analysts are saying about Amazon over the next 5 years. So they're saying over the next 5 years, they're going to be able to do 45%. So we could use that. The problem with stocks like Amazon is you're making really, really strong assumptions. You're assuming a huge PE ratio in the 50 or 75 range, and then you're also assuming that they're going to be able to do 40, 50% growth per year for 5 years, which is huge. And looking at their growth numbers, they have been growing very quickly, but not that quickly. If you look at their earnings per share growth over a 10-year period, 17%. So if we just assumed they continue to do 17%, let's do that. So 17% in the middle, then we'll go 25%, 35%, 10, and then, they won't do less than 10. 10 could be the lowest. Maybe we'll put a 15, 20, 25, 30 or something like that. 30% growth per year over a 10-year period would just be insane. So still, there's just a lot of downside. And really, it's just not worth the risk, right? Because there's other companies like Stamps, maybe not Stamps, but like when we had Apple back when it was $110 per share with $9 earnings. Like that's a much more attractive picture than what we're looking at with Amazon, right? And there's plenty of stocks out there, so there's no real need to go in at stocks like Amazon. And don't be fooled into the trap of thinking, well, Amazon's growing quicker, so it's going to offer better returns. That is absolutely not the case, and that's never true. Never believe that if someone tells you that. That is garbage. What matters is how much you pay relative to their growth and relative to their earnings per share. And that is what's really important at the end of the day. And that's kind of what this value matrix helps you do. It helps you work out relative to their growth on the side and relative to how the market will value them, what kind of return can we get, and what kind of return, what ballpark do we expect? And Amazon, it's just not going to be one. I'm going to cross it off the list now, and that's why I wanted to talk about it early on, because it could be a really great company, but the first point I'll make is that it's really confusing to understand because there's lots of components and lots of things you need to understand, whereas other businesses are really simple. There's just one thing. There's one sort of revenue stream like stamps.com. It's just their one service, whereas Amazon is a conglomerate. They have a bunch of different businesses, so it's hard to understand. Yes, they hit the moat probably. Yes, they probably hit the management, but that price is just way too high. So we're going to get rid of Amazon and we're going to narrow it down. I'm going to hang on to Apple because I think it's still good and the price isn't insane. If we chuck the numbers back in here, what did we have? Yeah, so it's not horrible. It's not good, but it's not horrible. So we're going to hang on to it, and we'll talk about Google and Stamps a little bit further in the next video. I'm sorry if I'm not getting a huge amount into each of these videos because I like to go through and explain each aspect really in depth. So I sort of just go through one or two stocks and just talk about one aspect in each video. So sorry if you're not enjoying that, but let me know what your thoughts are. And I've had a bit of feedback that seems to say that you guys want to know what I'm thinking about, what kind of things am I looking at specifically. And the best way I can do that is if I just talk off the cuff and just sort of explain as I go through really, really slowly. So I hope you enjoy that, guys. But that's all we'll do for today, and we'll continue off with Google and Stamps next week. Thanks for watching, guys. I hope you enjoyed this one. I will be back next week for another episode to continue our search and continue to narrow down and find really great businesses to add to our portfolio. If you enjoy this series and you want to see more, make sure you become a subscriber and join the team. But for now, I hope you guys have a great day. I'll see you in the next one.